There's a habit a lot of us picked up over the years. A new company lists on the SGX, you get an allocation, you watch it pop on day one, you sell, you move on. OCBC's mid-year outlook just told us plainly that habit doesn't work as well as it used to. I wanted to understand why, because if it's true, it changes how I think about the next hot IPO that lands in my inbox. A retirement instinct getting harder to justify. That instinct isn't unreasonable. It worked for years. Get in early, watch the debut pop, bank the gain. But OCBC's own research team is saying the ground under that instinct has shifted. So the real question isn't whether the old trick worked before, it's whether it still does. Here's the mechanism behind it. Since February last year, a 6.5 billion Singapore dollar government program has been pouring support into shares already listed and trading on the SGX. When the stocks you can already buy today get more expensive, a brand new listing asking for the same kind of price has to work a lot harder to earn it. Carmen Lee, OCBC's head of equity research, put it simply, existing shares getting pricier raises the bar for anything new trying to join them. That's the whole story in one line, and it's worth sitting with. So what does clearing that bar actually look like? Ada Lim on OCBC's research team gave a specific number. Unless a new listing can show earnings growth of at least 20%, paying an average market price for it doesn't make sense. That leaves a new company two honest options: price itself noticeably cheaper than its peers, or bring a growth story specific enough to survive real scrutiny. A famous name alone doesn't buy you out of that. Justco got plenty of attention when it listed. The share price since has been a different story. Familiar isn't the same as good value, and that's worth remembering the next time a big name IPO lands. Which brings me to the question I keep circling back to, especially for anyone thinking about this with CPF or SRS money in mind. Are you actually being paid for the risk you're taking, or are you paying a premium for a good story? Right now, the quiet re-rating happening in stocks you can already buy looks like the more interesting trade. We'll get a real test of this soon. Foundation Healthcare debuts this week, with OCBC acting as joint book runner. Healthcare has genuine demographic demand behind it. That part isn't in question. What's worth watching is whether this particular listing clears the higher bar OCBC itself just laid out, or whether it's another name riding a good theme without the growth numbers to back it. Zooming out, OCBC stays positive on Singapore shares generally for the rest of the year. They think valuations are still reasonable even after the recent run-up, and they point to Singapore's strong currency and solid corporate balance sheets as buffers against global noise. Where they're most excited is industrials, now the third largest sector locally, riding the global AI infrastructure build-out plus some regional tailwinds. Their own language is selective, not broad, which to me reads as, don't just buy the sector, buy the specific names actually doing the work. Now the harder conversation, the one that actually affects a lot of us directly. REITs have underperformed the broader market this year, and that gap widened after Middle East tensions pushed inflation worries back up, which made the US Federal Reserve more cautious about cutting rates. Higher for longer rates mean REITs carrying debt keep paying more to refinance it. OCBC's own Andy Wong is blunt about it. Avoid REITs with weak pricing power or a refinancing wall coming up, and stick with the ones actually growing their payouts. So here's the real question for anyone holding REITs for income. Can the strongest property managers grow fast enough to outrun their own rising interest costs? Or is the easy stretch of REIT growth simply behind us for this part of the cycle? The income from REITs hasn't disappeared, and neither has the refinancing pressure. Worth noting, OCBC's own preferred list only backs a handful of REITs, not the sector as a whole, which tells you something about how selective they think you need to be right now. Let's look at who actually made OCBC's list. 15 names, and notably, none of the local banks, OCBC's own team, seems to think the banking trade has already had its run, and the upside now sits elsewhere. Their modeled upside across this list ranges from 12.7% to 52.2%, which is a wide spread, so this isn't a uniform call across the board. The names are Bumitama Agri, Capitaland Ascendas REIT, Capitaland India Trust, Capitaland Investment Trust, Capitaland Integrated Commercial Trust, Hong Leong Asia, Keppel DC REIT, Keppel, Netlink, NBN Trust, Q&M Dental Group, SemCorp Industries, SIA Engineering, ST Engineering, Singtel, and UOL Group. I'll say plainly, this is OCBC's list and OCBC's conviction, not a verdict from our own coverage here. Some of these names get regular attention on this channel, plenty of them don't, so take this as one bank's view worth knowing about, not a checklist to act on without your own homework. Timing matters more here than people think. By the time research like this filters down into the free public conversation, the best entry points have often already come and gone. That's really the difference between catching real value early and walking into something that only looks good on the surface. It usually gets decided in a single trading session, not over weeks of thinking it over. If you want to see how Iggy actually screens names like these against his own thresholds, that full breakdown lives inside Iggy's Elite Investors, zero-day access, the complete Red Zone watch list, and the cheat sheets he builds for each stock for $9 a month, less than a Kopi and Kaya toast set at Raffles Place, and it's there the moment his analysis goes live, not after everyone else has already acted on it. Put it all together, and the bottom line is fairly simple. The IPO bar is higher because the shares already trading became more attractive first. Patience beats chasing the new listing hype. And if there's a place to focus that patience, it's on selective industrials riding real infrastructure demand, and a small number of REITs that are actually still growing their payouts, not the REIT sector as a whole. That's not a call to buy anything, it's just where the interesting questions are sitting right now. Which leaves me with one question I keep coming back to for my own portfolio, and maybe you're asking it too. Am I holding REIT exposure because I actually did the work on it, or just because that's what income investors have always done? Those are two very different reasons to hold the same unit, and honestly, only one of them holds up against what OCBC is describing here. Worth sitting with before your next dividend season. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS-licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.